Gary Singleterry, why do I want to own mortgage-backed securities right now? Is it the spread over Treasuries or the improvements in the housing market?
A little of both. A lot of the mortgage-backed securities market still offers very attractive spreads over Treasuries compared to, say, the corporate bond market. And we do have an improving housing market. So in the non-agency area in particular, that provides pretty good value if you know what you're doing, know what to look for. So we still like it for fixed income.
All right, let's talk about the credit market first. So what is the Fed going to do? When are they going to do it? And how will it affect mortgage-backed securities?
The Fed, the $64,000 question. The Fed will raise short-term rates, not sure when, but they'll do it slowly, and they won't do it very far. My guess is that they will have a small impact on the mortgage-backed securities market. The forward market and the long-term yield curve has an expectation that the Fed will raise rates already built into it. So I don't think it'll have a major impact at all on the mortgage-backed securities market.
So with this in mind, do you like agencies? Do you like non-agency mortgages? What are you seeing in the market that you like?
Well, we like non-agencies. You know, the Fed has basically dominated the agency market since 2008. And they're reinvesting all of their principal and interest payments, so they've really taken a lot of the yield out of that market. So we find the agency market fairly unattractive, but in the non-agency market, which is still a fairly sizable market, we're finding much better value. So we like the non-agency market.
Now let's talk a little bit about housing. We saw pending home sales down, and that was unexpected, but existing home sales were good. So tell me about the housing market overall. Nationally, it seems pretty good, but I guess there's still pockets of problems.
Yeah, the housing market has pretty well recovered from the crisis. Nationally, we see prices pretty much back to the long-term trend line. So we're at, and we also see the number of vacant and unsold homes back to a reasonable number, 4 to 5 months supply of unsold homes. So it's sort of back to normal on a national basis. Regionally, there's big differences. We've got some markets that are back to their all-time high in 2006. We've got a lot of markets, though, that overshot in 2006, and they're still not back to their all-time highs because the all-time highs were just way too high. So regional differences, but nationally, it's pretty stable now.
And then finally, let's talk about this trend towards unconstrained bond funds, because we keep hearing about them. Nobody wants to deal with a benchmark anymore. Everyone wants to go all over the place to find yield because it's hard to find. So how is this affecting the market?
Well, people are trying to lose duration. They're trying to find value in a very low interest rate environment, and that's creating a lot of problems in a lot of parts of our market. We manage, at GAM, we manage a big unconstrained bond fund, several bond funds actually, unconstrained. So people are looking for floating rate securities where they're protected against rates going up on the short end. In the mortgage-backed area, we own some interest-only strips, and there's been a lot of people moving towards the interest-only strip market, so the yields are down in there. So it's been very tough. And people are concerned about rates going up, and rightfully so. So it's keeping yields fairly low all over the place. It's tough to find value these days.
All right. Well, thanks a lot for coming on and talking about it.
You're welcome. Thanks for having me.
And thank you for watching The Street.